Hello, everyone, and welcome back to the PetroNerds podcast. My name is Trisha Curtis. I am the CEO of PetroNerds and the host of the PetroNerds podcast. Happy New Year's to everyone. This is your first PetroNerds podcast out of the gate for 2026, and we are going to get PetroNerdy in this episode. So, this is a special podcast. I've been waiting to drop this for a long time. If you've been listening to the PetroNerds podcast, you know that there's been a lot of intel, a lot of speaking, a lot of presentations in the queue. We have more coming up, but this is a long-awaited podcast. This was the Houston Producers Forum that I did in September. Trust me, this is not a podcast or a conversation that is dated. This is extremely timely, and I just re-listened to it. It is a really, really phenomenal conversation. But before we get into that and the recapping of this Houston Producers Forum, there's a lot to cover right now because today is Tuesday, January 6th, 2026. It is 1/6/26. And I'm not going to pretend like everyone else who's gotten on TV as of late that they're just Venezuelan oil experts coming out of the woodwork. Everyone and their dog is getting on TV and talking about Venezuelan oil. I hear a lot of percentages. I don't hear a lot of figures. And so what I'm going to try to do today is what I've been doing with reporters and what I've been doing with clients is really sort of, I've been leaving a lot of voice text over the weekend and giving you my honest take of what I'm seeing. Right now, we are seeing oil prices as of today, as of Tuesday, January 6, 2026, we are seeing oil prices depressed. Now, there's a lot going on with that. And I am hearing a lot of commentators come out and saying the oil market has this right. I disagree with that, but I have been disagreeing with the oil market being oversold to the extent it has been. I mean, I've been on the record for saying I'm not an oil bull, that I think we should be 85, but we damn sure should be closer to 65 than we should be to 55 right now, just on the basics of this geopolitical volatility. And it is not just Venezuela. But what happened was over the weekend, and if you were staying up late as I was and you saw your phone pings that, there was explosions and stuff going on in Venezuela, and that was clearly obviously the US, and then the US extracted Maduro and his wife. So we now have Maduro and his wife in custody. They just appeared in New York. And the market reaction, if this had been any other country like in the Middle East, we would have seen a price spike in oil. But that's not the market reaction. And so I think that there's a few things going on. Is that one, we definitely have a lot of oil on the market. So that is a real thing, that there's a lot of oil on the market. U.S. production figures, if you haven't seen them, they came out December 31st on New Year's Eve, and they are 13.87 million barrels per day as of October. So we could easily, now that number could come down, but we could easily clip the year of ending the year of 2025 at 14 million barrels per day. That is significantly higher than anyone, especially abroad, really thought where would be. Probably 800,000 barrels a day more at least than many folks in OPEC actually thought we would. They thought we would peak at sort of 13.2. So we're high there. And then this oil on the water, which gets back into Venezuela in a second, we do have a lot of oil on the water and we have a lot of oil in the market. However, the response should have been that geopolitical risk is that regardless of if you agree or disagree with what the ousting of Maduro, that the answer should have been to an oil-rich nation that oil prices would go up, just based upon geopolitical risk. And we have an ongoing war in Ukraine. We don't have an end in sight with that with Russia and Ukraine. So we have the ongoing war. Russia produces just under 10 million barrels per day right now, probably with liquids and condensates over 10 million barrels per day. But I'm going to get into these figures in a second because I am not hearing commentators on TV actually discuss this. So what I do when something like this happens, I don't just reach out and start making stuff up as I hear a lot of people doing, actually think about it. And so what I'm going to tell you is that Venezuela is producing, as of OPEC figures, 934,000 barrels per day as of November 2025. So that is just under a million barrels per day. And that's actually an increase from 2023. On average, they were producing 760,000 barrels per day. 2024, they were producing 867,000 barrels per day. Now, under a million barrels per day. So all the market commentators who've been saying the oil market's getting this right and we should have some selling off on oil prices. I just saw a $56 handle. We're at 57.13 right now as of recording in the late afternoon, about 4:30 p.m. on Tuesday, January 6th. I've not bought into this overselling because this is still a million barrels a day. Now, what's happening, and the reason why they're saying, Venezuela doesn't produce a lot of oil, partly what's happening is that Venezuela produces about a million barrels a day. almost all of that crude oil is going to China. Now, some of that crude oil and some of this economic support is also going to Cuba. And that's why Trump's comments when he was on Air Force One on Sunday, his comments that if you're watching the news flow and watching the market on Sunday night, you would have heard him talk about Iran, you would have heard him talk about Cuba falling. And so these comments to me should have propped up oil, absolutely 100%. You have protests in Iran, you have Trump saying that he's willing to support the protesters in Iran, and you have saying that Cuba's going to fall, not because the U.S. is going to be involved in Cuba falling, but because Cuba is a mess and because Cuba gets support from Venezuela. Now, super important to point out is that I will be on the record saying I do not think this is about oil. If I'm the Trump administration and I'm trying to push China and Russian influence out of my backyard, I'm probably going to let the market go ahead and talk about oil. Trump did comment today that oil prices are going lower. I wish he would not do that. I think at 14 million barrels a day and the largest oil and gas producer in the entire world, we need to we need to have slightly higher oil prices. It would be good for the economy. It would certainly be good for oil and gas production. And I definitely think that's a message that, at the very least, the Trump administration needs to stop talking about low oil prices, because we already have very, very low oil prices, or pretty low oil prices. Very, very low might be a stretch. So what happened, though, was Maduro was captured along with his wife. The current vice president, who is now in Rodriguez, to my knowledge, was actually in Moscow. So the vice president, who's now in power, quote in power, was in Russia at the time, and the hours prior to us taking Maduro, the Chinese were actually visiting with him and is visiting in Venezuela with Maduro. So the Chinese and Russian influence is significant. And the reason it's significant is not necessarily because everyone needs this crude oil, but China does buy most of this crude oil. So China buys almost all this sanctioned crude oil. They're buying the crude oil from Russia. They're buying the crude oil from Iran. They're buying this crude oil from Venezuela. All this is sanctioned. Now, the enforcement of these sanctions and what we've done with Venezuela has been ad hoc and relatively messy. We have not had a 100% blockade. We have been allowing ships out. We have seized some ships, but we have been allowing some out. Now, part of the market response or going down, I don't think the price going down is warranted. But we do have some short positions on Brent, which is pushing that. However, part of the reason that this not going up in prices is because people are saying, well, we weren't actually exporting that much Venezuelan crude to begin with, and that does make sense, right? The U.S. has had activity in Venezuela for the last several months. We have not had a full-on blockade, but we have been blockading ships. And the role of Venezuela and Iran and all these countries, it's a lot of the shadow tanker fleet, right? They're moving a lot of crude around. They're obfuscating it, pretending, that it's coming from Oman or Malaysia, and then sending it to China. And so probably the estimates are as high as half of that crude oil production, about half, 500,000 barrels per day or 500,000 barrels a day, hasn't been leaving Venezuela anyway. So the fact is that we're not having a huge impact on it. And then the optimism on these oil prices going down, or what people are saying, is that, the Trump administration and everyone is talking about we're going to increase output. Now, I just want to caution folks on that. It's not that we cannot increase output. We are actually pretty good at producing oil in this country, in this world, but we tend to do a couple things when we have geopolitical risk that turns into geopolitical reality like this. We do get it very wrong on the oil side. I think we're wrong on the oil side in terms of the pressure on oil prices and the upside. The optimism is coming around the fact that if there are U.S. companies and U.S. influence, that they can increase this. Everyone's talking about the infrastructure and the dilapidation and all those problems. But what we do is we always say we have an attack on, like when we have attacks on Saudi Arabia in 2019, oil prices spike, but then they came back down because oil production wasn't really impacted. We see the same thing when we're looking at refineries getting attacked in Russia. We've had up to 40% of refining capacity impacted in Russia by Ukrainian missile and drone strikes, or drone strikes and hitting them. But they bring that refining capacity back online. Yes, that has impacted local distribution of refined product. Yes, that's impacted the market to a degree, but not much. And so a lot of this geopolitical tension is getting masked by the fact that we have a lot of production on the market, and we're very, very good at when we have an outage, we can bring it back. But I would say that the market has a tendency to, they price in this geopolitical risk, and then oil prices correct because production is actually impacted. And I would say that production can also not be impacted on the upside. And I would caution people to think about, say, Iraq, for an example, right? In 2011, 2012, when Iraq was really trying to increase output, or stating that they would increase output, they said they were going to go to 12 million barrels per day. And I'll tell you, as of late, Iraq, we're looking at the latest production figures, they're 4 million barrels per day. Still a lot of crude oil production. I think some of that crude oil is actually coming from Iran, which is a problem. but it's not 12 million barrels per day. So it isn't that these countries can't produce oil. It's that they have above ground issues that prevent them from producing oil, contract issues, getting companies in, solving all those things. Really important for Venezuela, backing up to China, because everyone knows I love to talk about China, but it is really, really important is that Venezuela has massive debt with China. So something like $100 billion. Now, most of that debt is getting repaid in oil, and their oil is discounted. The purchase of that oil is discounted up to $20 a barrel. So massive, massive crude oil discounts that China is getting for this crude oil. So this does impact China. This is a wake up call to China. China has incredible economic ties with, in not just economic, but also, everything with China is more than about economics. But China has incredible influence and economic ties within Latin America, within southern countries, in America or in South America. Brazil, they're the number one trading partner. I've talked about Brazil slapping tariffs on steel because they were having all kinds of issues with China. This is a really, really serious thing in terms of the economic influence. And I would say this is probably more than just about economic influence. It's not like the Pentagon, opened up their notebooks and said, "Oh my gosh, China has economic influence in Latin America. Let's do something about it." It is probably that there's more stuff going on. Clearly, the Russian, when we're talking about Cuba, when we're talking about Venezuela, when we're talking about all these countries, the role of Russia and China collectively, the presence and their influence in Latin America is significant. So I think it's probably more to do about that than specifically about just the ousting of Maduro and just about drugs. But we can put a pin in that for the moment, because I will just say that also the coverage. So for everyone and the dog getting on the stock market and talking about Venezuelan oil and using percentages and not actual figures, I think is very interesting. The U.S. is producing 13.87 million barrels per day. So we're producing almost 14 million barrels per day, which is a massive amount of crude oil. And so in comparison, yes, Venezuela is not producing as much. But what was also interesting is the China rhetoric that was coming out. So on Sunday evening, if you're listening to Bloomberg, which is exceptionally biased and pro-China, they brought a couple folks on TV. They had a guy from Tsinghua University, he's actually a former PLA colonel, and then they had a guy from Victor Gao also on, and they gave them both roughly 10 minutes of more than airtime, so probably about 30 minutes airtime for both these guys to essentially shred the U.S. and to say that the U.S. is going into decline, that this is the precipice, this is going to send the U.S. over the edge, and that we aren't rule of law, we're not a country of freedom, and that China is the answer, and to look toward China. And actually, one of these guys was talking specifically about Taiwan and saying that, the forces are inevitable, that China is becoming closer to Taiwan, and they will eventually converge. So I think there's a lot being said here, is that, China is definitely using this as a moment to seize the moment and say, "Oh my gosh, you can't believe this." But really, you're not hearing as much out of China as you probably thought you might. And that is because China is looking at this very hard and very serious, because they do have undue influence in the global, or in Latin America and South America. And so when I heard these commentators come out on TV from the China side, and they said, "Oh, we have basic economic influence. We have basic economic ties in Latin America. I mean, we buy cherries from Chile." And it's ridiculous, right? They buy way more than cherries from Chile, right? They're buying these critical minerals. They've been buying oil for decades, and then they had this opportunity to buy all these critical minerals. So they are getting stuff from Argentina, from Chile, from all these countries, including critical minerals, and then they're refining those minerals and rare earths in China. So it is really, really serious. And so those economic ties, you have to remember that, yes, it can just be economic. It's never just economic with China, but those economic ties are what prevent these countries from pushing back, right? It's not dissimilar to what we see with Russia and Ukraine and all these countries severely pushing back on Russia. I mean, we see this within Europe. Nobody has been really willing to push back too hard on Russia, because they're still buying natural gas. They're still buying oil from Russia. And that is just the reality that we live in. And they've had this playbook for about 40 years where they increase these economic ties, and then they want to, if you want to push back, then you get economic pain. And this is all these countries are intertwined. So you did hear in the commentary, not very detailed, but you did hear a lot of this over the weekend, which was Iran, Cuba, the Venezuela issue, but the linkage to Iran, the linkage to Russia, and the linkage to China, and how all these guys are working in this together. You also actually had North Korea launched some missiles over the weekend as well. So you're not hearing as much about Russia right now. You are not hearing about these North Korean missiles. Those are significant. That should have put a geopolitical risk premium on oil, in my opinion. And you're also not hearing about you've got this stuff going on with Iran, but throughout all these nations are working together. So all these nefarious actors are utilizing their strengths and collectively together, and they are using a lot of these shadow fleets. But the fact that China is buying all this crude oil, a million barrels a day, or roughly around that, or most of this crude oil, most of this is going into stockpiling, or a degree of this is going into stockpiling because China's probably consuming around 15 million barrels a day. They're probably stockpiling 2 million barrels a day. So in that sense, yes, you wouldn't have a massive impact to the market. But the reality is that they are heavily involved. They're heavily invested in these countries. And I think this is a wake up. Should be a wake up call to the market to think about more about China and Russia and various actors and influence in these nations than solely about the Trump administration wanting to get oil out of Cuba, especially given we're the largest oil and gas producer in the entire world. Now, that all being said, where we are seeing the geopolitical risk, right, where we're actually seeing geopolitical risk, the premium, we've seen the market kind of slough this off, right? The stock market is ripping higher. We've seen a lot of optimism on AI. You have the big tech thing going on in Las Vegas right now, and Jensen Huang is all over the news, and there's lots of talk about autonomous driving and how AI is working with that. So that seems to be off to the races. And so the stock market is selling off oil. The stock market's going up. I think you're seeing some economic data points where we're seeing some disconnect in the stock market, where which we've seen over the course of the past year, where folks are thinking the Fed's going to cut rates. But we're seeing the 10-year Treasury. We're looking at the 10-year Treasury yield at it's above 4%, it's 4.169%. That's keeping mortgage rates propped up well above 6%. So there's some stuff going on there a little bit, right, with this 10-year yield and with what's going on there, that we're not seeing that come down. We've got so you've got Brent oil prices at 50. We're WTI right now, West Texas Intermediate, 57.13. We've got Brent at $60.58. Now, we do have some short positioning on Brent. And that's what's weighing on, I think, to a degree. That's why you're seeing this flirtation down, where we saw a 56 handle dollar today on WTI. We've since come back. We're at 57. We saw 58 yesterday. It's a little, I wouldn't say it's all over the map. We're in about $1 a movement swing. But we should be at least $60 a barrel for WTI, given this geopolitical risk. So what we have seen this manifest itself is in gold and silver. Back to my comment on where this is manifesting itself in geopolitical risk. We're not seeing it really in the stock market. We're seeing Asian stocks go up, everything. But the geopolitical risk in gold and silver, we're seeing gold at $4,500 an ounce. We are over $4,500 an ounce. And silver, sorry, I don't mean to cuss as more than I should, but silver, we're looking at $81.22. That is absolutely incredible. Now, and for an ounce of silver. So an ounce of silver is worth way more than a barrel of oil right now. We had a point where it was at parity, but that's just massive, right? I think we have to really put that in context. And part of this is because of all the way the Trump administration is listing critical minerals, is that lots of stuff is being included in that. And there is some talk about and thinking about how we are stockpiling this. We're seeing copper just ratchet up massively higher. We're seeing copper hit all-time highs, along with silver and all these other metals. And so there's a lot going on in that space. But I do think we have a disconnect where certainly we have a lot of crude oil in the market, absolutely. But when we have the stock market kind of sloughing this off, and then we've got metals ripping higher because this geopolitical risk premium is something, there does seem to be a disconnect. And I do want to loop this back a little bit to this oil on the water and the role of China here. So when we have this oil on the water, and we have this relatively depressed oil prices. When we did this talk in Houston in September, we had oil prices at $62 a barrel. Now we're looking at a few dollars, about $5 less than that. I would say we are depressed for oil prices. And I don't think this is necessarily where we should be. But part of that is those short positions, the biggest short position we've had on Brent in 10 years. And we're at the first quarter of the year, where we always have this kind of outlook for oil prices that's not great. Now we had OPEC. OPEC actually have their meeting over the weekend when the Venezuela stuff was happening. They met for 10 minutes and basically just agreed to do nothing. And Venezuela is a member of OPEC. So OPEC's being uncannily silent right now. But all this oil in the water, which is very real, we're not seeing this manifest itself into oil barrels on land, right? We're not seeing massive stockpiles on land go up. And so I would just caution everyone to think about this oil on the water, is that yes, we have an increase in OPEC output, but we have a lot of output from sanctioned countries. So countries like Venezuela, countries like Russia, countries like Iran, where it kind of moves around and then it has to obfuscate, right? It has to go to a different country, it has to get into a different ship, and has to move around. You end up having more oil on the water because of that. So because we have so much production coming from sanctioned countries and China purchasing so much of this, that's leading to oil on the water. And China is artificially holding up the market to a degree because they're stockpiling so much crude oil. All that being said, we do not have a cratering in demand. We have not had demand come off a cliff. We just have a lot of supply. And so there is a balance here and a level set where I don't think traders are appropriately evaluating geopolitical risk, but I don't think we're necessarily on a day-to-day basis reflecting supply and demand fundamentals of what's happening. You certainly wouldn't just sell off oil because you have somebody ousted. It just doesn't make sense. The geopolitical risk premium is not in oil, and the overwhelming thesis is that we just have all this oil on the water, which is just kind of being moved around because of these sanctioned barrels. So there's a lot of confusion there. And then I want to talk about natural gas, because we're going to talk about this quite a bit when we get into this. When we get into this conversation, that we're going to talk a lot about power. We're going to a lot of talk about AI. We're going to talk about natural gas, and we're going to talk about frac and peak shale and all this awesome stuff with these amazing CEOs that I have on this panel at the Houston Producers Forum. But right now, I just want to comment. Natural gas is sitting at $3.35. That is an incredible sell-off from the $5.28 that we saw only weeks ago on December 4th. So a month ago, we saw over $5 an MCF. And you know what? I heard a lot of folks talking about this is the year of natural gas, and this very well could be. But we are definitely, if you're looking at the production data, you are seeing that from a monthly standpoint, we're still 130 billion cubic feet per day gross withdrawals. And so we aren't massively increasing output on the production side as of October. We are increasing those LNG exports. Those are staying around that 5 BCF a day increase that I have talked about. And so we had that pop in prices, but we since had that depression, and that is because of this warmer weather, unseasonably warm weather in the winter. And, if you're looking at the stock levels, they're up. The only point I'm making with this is that I think we need to be very cautious as an industry in thinking about the times we could hedge, right? The times where I think you're going to have an opportunity. We certainly should have seen some hedging at $5 an MCF, because that's very high. But I think you're also going to see some opportunity where we have some, where we do flirt higher with oil prices, and those might be some opportunities to hedge. So I am talking to my clients a lot about this and the trajectory of oil prices. We are going to talk way more in future PetroNerds podcasts about that. But hopefully that is helpful to recap you on where we're at with this Venezuela stuff, trying to not be one of the incredible Venezuelan oil experts that just popped out of the woodwork overnight. And lastly, I will just say on OPEC production, before we're looking at over 10 million barrels a day for Saudi Arabia. So keep all this in your back pocket. 10 million barrels a day for Saudi Arabia, which they have been at as of October, and over 10 million barrels a day in November. They are showing 9.4 million barrels a day for Russia. They're probably a little higher than that, but there is a lot of production, and you're seeing Iran at 3.2 million barrels a day, and you're seeing Iraq at over 4. And Iraq is the country that is asking for higher output increases, but we're seeing some muted stuff going on with OPEC. So with that, folks, it is January 6th, 2026. This conversation, I've been waiting to drop this. I just re-listened to this. It is a really phenomenal conversation. It is rare to have a room packed like that with such incredible folks in the room. This was an evening event in Houston. It was a sold out crowd at the Houston Producers Forum. And the panelist I have is the CEO of Calpine, Andrew Novotny. He's just a wealth of knowledge when it comes to power and AI. We have Liberty Energy, the CEO, Ron Gusek, does an incredible job talking about peak shale and technologies, and is really quite fun in the panel with Andrew and Sheldon. And then lastly, we have the CEO of Rockcliff Energy, who talks in a great perspective on natural gas and the private equity space, Sheldon Burleson. So without further ado, I hope you guys enjoy this PetroNerds podcast. There's a lot coming down the queue. 2025 was an incredible year for the PetroNerds podcast. There's a lot of folks listening, a lot of folks watching. We are going to have a lot more this year. So if you are interested in sponsoring, or interested in this intel, or becoming a partner with PetroNerds, reach out to the PetroNerds website at petronerds.com. And I very much look forward to talking to you soon, folks. Bye.
First, want to thank everybody for being here. My name is Phil Delozier, and I'm with the Houston Producers Forum, and on behalf of our board, we welcome all of you. This is a real special event for us. We normally do not do evening events, but frankly, we had such great feedback when our friend Trisha Curtis spoke earlier in the year that several people obviously wanted to hear all Trisha's ideas and her colleagues. So we're really happy that she's back with us. As you all may know, Trisha is the president and CEO of PetroNerds, which was a firm she founded in 2015 and has been working pretty full-time on that since 2016. Trisha is a graduate of Regis University in Denver with a degree in economics and politics. She actually also has a Master's of Science degree from the London School of Economics in international political economy. We're also really delighted to have on the panel Sheldon Burleson, who's the CEO of Rockcliff Energy. Sheldon is president and CEO of Rockcliff, which is a privately held company here in Houston. It's backed by Quantum Energy Partners. Sheldon has over 24 years of experience in the oil and gas industry, both in the U.S. and internationally. Sheldon has a BS degree in petroleum engineering from Texas Tech and an MBA from Tulane University. We also are pleased Ron Gusek is here with us, who's the CEO and President and Director of Liberty Energy. Ron has served as Liberty's Chief Executive Officer and Board Member since February of 2025 and President since November in 2016. He has over 25 years experience in the industry here in the U.S. as well as internationally. Ron has a Bachelor of Science degree in Mechanical Engineering from the University of Alberta. Our final panelist is Andrew Novotny. Andrew is the President and CEO of Calpine. Andrew became Calpine's Chief Executive Officer and a member of their board in October of 2024 and has also served as President of Calpine since May of 2023. Andrew holds a Bachelor of Arts degree from Vanderbilt University in economics and has also received a Master's of Business Administration from Rice University. With that, I want to be sure and turn over things to Trisha. So thank you all for being here.
Thank you, guys. Are we on? Can you guys hear me? Okay. Nope.
It's okay. There you go.
Okay, sweet. All right, you guys can hear me. So this is an awesome turnout. And I have to say, massive thank you for the panelists for agreeing to speak. And I told them I wouldn't throw them too many curveballs, but you're all here, and we don't want to be too boring, so there'll be a few curveballs in here. And I have to give a huge thank you for you guys to attending and to the Houston Producers Forum. Josh Sherman helped me put this together with Opportune. And when I was here in March, the turnout was amazing. The feedback was really, really amazing. And I had been just doged. And so it was a nice ego boost to everybody needed intel. So it was really great. And then Josh and I were like, we should do this again. And I thought, how awesome would it be to do an evening event with, where you guys can enjoy some beverages and we can talk about the market. And from March to now, it hasn't gotten less boring. It's pretty exciting right now, and we have a lot to cover. But we have three amazing panelists, and I say this because, some of the biggest topics we have right now are, I don't want to say depressed oil prices, but not exciting oil prices. So we're at 62 and change for oil. We hear about white space on the calendar on the frac side, but yet we see a lot of resiliency in U.S. oil production at 13.6 million barrels per day. And the really hot stuff, natural gas, everybody's excited about natural gas, and everybody's very excited about AI. And so when we think about those things, we think about power generation. So we have three amazing panelists to address a slug of this stuff. And I'm going to intro just a little bit by saying, we had Israel hit Qatar just last night, and yet we didn't see a bump up in oil prices. So we have a lot of things happening, I think, in the world with an ongoing war with Russia and Ukraine, with still an ongoing war with Israel and Hamas, and we don't have this movement in oil prices or this knee-jerk reaction in oil prices. So we clearly have a lot of supply in the market. On the nat gas side, we do see a lot of excitement. And I don't think a lot of folks had in their bingo card the amount of momentum and excitement that people would have at $3 an MCF. So that's something I definitely want the panelists to address. And then peak shale. I was just on somebody else's podcast this week, and I was in DC last week, and I can't tell you how many people ask me about what is the production potential of the U.S. We hit 13.6 million barrels per day, but what is this peak shale, and is the Permian rolling over, and are we done in the U.S.? And so those are big questions and hot topics. And then artificial intelligence. And where we're going, that's a huge one, and how we use the natural gas, because that's what has everyone excited. So, are you guys ready?
Ready.
Okay, awesome. Okay, so Ron, why don't we start with you, because I feel like I know you a little more, so you're okay with he's just been on the podcast, by the way, so if you want more of this, you can listen to the podcast with Ron. Ron, so why don't you address the topic of a little bit, if you want to get into kind of just the state of the oil market, the oil and gas market, the fact that we're at $62 a barrel, but people feel kind of pessimistic about it, that you and other frac companies have talked about white space on the calendar in the second half, and that it's not a bad market, but it's not the most ripping, exciting market. If you could just kind of address that a little bit.
Oh, there's a lot to unpack there. So, where to start? Been a bumpy year. I thought when we sent Chris off to DC, things would get a little smoother, but it turns out he's done completely the opposite for us. So just trying to make my first year exciting, I think. So we've seen oil prices dip into the 60s, climb back up to the 70s for a little bit, and now back into the 60s. And of course, that's brought with it an immense amount of uncertainty. And certainly from the service company side of things, that's not without some challenges. I am of the personal opinion that I think the producers in North America are not willing to cede meaningful market share. And so as Trisha alluded to, we've seen production relatively resilient at 13.6 million barrels a day. I am of the personal opinion that we probably don't see that number fall too far, that there's a real lack of willingness to cede that market share to the Middle East, barring a major drop in oil prices. We still have this perceived overhang, and there's a lot of debate around that, exactly how big the supply-demand imbalance will be. You've got OPEC Plus on one side saying that they're quite bullish demand looking out into 26 and 27. You've got some others on the other side of that talking about a couple of million barrels a day of overhang. You've got some people in the middle that don't believe OPEC's going to be able to deliver all the barrels they brought back, and the demand may prove to be a little stronger than some of the forecasts out there. All of that said, we still have a situation where nobody knows the answer. Crystal balls are still pretty fuzzy, and as a result, we see a reluctance to be too aggressive on activity. And that has meant, as we move from the first half of the year into the second half of the year, on the oily side of things, a reduction around activity levels. We absolutely have more white space on the calendar. We have operators seeking to find ways to be more efficient. They're working to drive down the cost of producing a barrel of oil or an MCF of gas. Part of that has come in the form of pricing. So we have seen a deflationary pricing environment on the service side of things. A meaningful amount of that's coming through efficiency. We're running probably 25% more simul-frac fleets this year than we were last year. That means more lateral footage done on a daily basis, and as a result, better utilization of that frac crew, more efficient use of the other daily assets that are sitting out there, and so we continue to drive down that cost. And I think if you look at the E&P community today, you would see even at $62 a barrel, pretty healthy free cash flow, easy sustenance of a dividend, and all in all, not too bad a picture. Fast forward to the end of the year, I think there's still a reasonable expectation, at least I think that's what's reflected in our stock price, that oil dips into the 50s, and we will see activity plans for 2026 reflecting that. We're just getting into RFP season today, so it's a little early to say that, but that's what it looks like. So I think on the oily side of things, we got at least 12 months of challenging outlook in front of us from a service standpoint. Maybe the back half of next year we start to dig ourselves out. The gas side's been a little bit different of a story. We definitely had some tailwinds there even as early as Q2 of this year. That's pulled back a tiny little bit when gas dipped under $3 there for a little while. We've seen production get shut in. We've seen some activity deferred out of Q3 and into Q4, and maybe even push out into 2026. Winter weather is going to have a lot to do with it. Unfortunately, I think here in Houston you had a relatively mild summer. Damn it, that was bad for gas. Wish you had a few more cooling days to deal with here, but as it is, we came out of the summer in a pretty strong gas position. If we don't have a very, very cold winter, we are going to run through the winter in a very strong gas position, and that probably holds gas prices depressed into next year sometime. But out beyond that, absolutely bullish gas. I think we're going to see rig count climb in gas, if not in the back half of this year, certainly into the early part of next year, and completion count follow that. So pretty excited to have that piece of the puzzle in place. All in all, holding out for the back half of 26.
That's great summarization to begin. I should also tell all of you that I'm gonna control this to be roughly an hour, and then we're gonna open this up to Q&A for you guys. So if you've got burning questions, keep them going. You're welcome to ask all of them. You're also welcome to ask me questions. They're also welcome to ask me questions too, so they can just throw it back if they want to. So the nat gas thing, you closed on that, so we'll lean over it for you, Sheldon, onto this nat gas side and the private equity side. Because for all the, any pessimism I hear from folks on that are a little concerned on the oil side, I hear plenty of optimism on the nat gas side, and I hear plenty of optimism, honestly, from the private equity side. So if you can give us some color on that, and obviously you can speak to oil as well, but free reign, and I can dial in on some questions as well, a little bit more.
Okay, yeah, so I think you're spot on. I think there is, probably more constructive optimism around natural gas, and so, I think there's, been two key things that have been driving a lot of the story on oil and natural gas. But on oil, I think it's been primarily capital discipline and consolidation, and so you've seen a lot of that, a lot of the consolidation happen, and so people have really focused in on, what's the best opportunities they have, and so you've seen some of that pullback in activity, and so I think if you look at the historical trends, up until really 2024, you were seeing like big improvements on kind of how much productivity per foot was coming out of wells, oil and gas. Kind of saw a little bit of a dip, and then we've started to see that kind of come back a little bit as people have kind of high graded their positions. I've been around this, like I said, for 25 years. Worked at Chesapeake Energy for a long time, and so there's lots of those years where like, okay, the next 2 years is going to be the gas story, and we were excited about that. And so as I sit here today, Rockcliff, we've done a lot of work on gas, and we have that optimism back. But I think this time there are some things that are probably driving a little bit different viewpoint to help kind of buoy that optimism. And so I think it's really a couple things under the fundamentals. And so I obviously have the LNG story as a big one now. And so if you look over the next year or so, there's about 5 BCF a day of additional LNG coming on, and then another 10 or so over the next 2 years. So if you look at that, although we've reached kind of peak production at about 107 BCF a day this past year, there's a lot more demand there than there has been historically. You also have the power gen side has been a big story, and I'm sure we'll hear more about that from Andrew. And then the wild card has been the AI side, so 4 to 5% increase from that. So you got some of those fundamentals there. I think the other thing that's critical is as we touched on, weather is a factor. I think if you look historically, gas was very regionally driven and very weather driven. I do think there's still a weather component there, but I think now that you've got enough LNG exports and you've got this other demand, it's really kind of buoying where you still see those seasonality in the prices, but you don't see those huge swings like you had in the past. So on the private equity side, last year when we kind of were starting back up again, we worked on a lot of oil deals, and everyone felt that was more constructive. And it felt like for quite a while there, it was either everybody decided to hold their asset because they thought, well, better prices are coming, or some of the publics kind of went and scooped everything up. And so, what's shifted the last year is really looking in detail to say, hey, we think that constructive view for gas is going to happen over the next 3 to 4 years. And so it feels like you kind of structurally shifted higher, whereas we used to be really worried about kind of $2 floors. Now it feels like 3 is more the floor, and then there's a lot more upside going forward. And I think if you look at the strip over the next 3 or 4 years, although the front months have been lower here the last month or so, the strip looking a few years out has stayed pretty stable and pretty steady, even up to that 4 and above. And so I think that's what's given everyone kind of that optimism that, hey, we've got a lot of drivers coming in the next 3 years that will help prop up that demand, even though we had a lot of supply come on.
Right. Well, this segues perfectly into the power side, but I'm going to front load this a smidgen because there's a few things I want to mention before we get into this. So the 130 BCF a day. I mean, I can't tell you how interesting it is to me to study the market and hear the optimism I do on nat gas, and that this kind of feeling of pessimism at $62 oil. $62 oil is not the worst price in the world. It's not amazing because we've had inflation, and so it's not awesome. But it's definitely not 52, and that's how the market kind of feels right now. It's like it's 55. So this optimism you're saying on nat gas. I was just in Washington, D.C., and I think everybody is talking about, okay, where's it going to run, and is it power generation and LNG? And I would say the single biggest things on nat gas that seems to be that 130 BCF a day of gross withdrawals that we're producing is the incremental moves on LNG, right? That we starting to have a home if we can get another 5 BCF a day, or 6 BCF a day, or 7 BCF a day that can have a home, in LNG. That's awesome. We still need more ships to be built. But then it's really about power and AI. And this is the really interesting piece on the power gen is that, you guys are the largest
natural gas provider of power in the US, correct?
Correct.
Okay, so the front loading of this a little bit, I just have to say is that, just to put this in perspective, because I hope somebody's going to ask about China. Please ask about China. We have about over 10,000 terawatt hours of power globally. China has over a third of the world's power generation. Now that should give everyone like concern and pause and all kinds of questions. But that's over 10,000 terawatt hours. Now of that 10,000, they have 5,800. Over 5,800 of those terawatt hours are coal-fired power generation. Now why that's important to me is because it's very reliable, it's very dispatchable, it's extremely energy secure. It's actually like a rock that you sit beside of a power plant. You don't have to compress it like natural gas, and I love natural gas, but it's very, very different. And so just keep that in the background for a second to think about, because we have about half that power generation, but there's so much momentum on natural gas and AI. So with that, when we talked, you started talking about NVIDIA and Blackwell and AI. And one of the first things before we get into the nat gas and power, a hard question I have for you is that everyone just assumes that, it's this simple value chain. From the wellhead, people are so excited about nat gas. Can you explain simplistically the value chain between the molecule of nat gas to AI? Because I think the bets we're going to have feels a little bit like the pets.com, the .com bubble of we may not have this value chain execution perfectly and the hyperscalers and how it's being used. You can attack that any way you want to, and we can dive in a little bit further.
Okay, good. Yeah, no, there's a lot to unpack there. So look, first, maybe I want to throw some numbers out. So to do that, let me level set with this audience, because I think there's a lot of oil people here. So let me give some just power numbers. Our country's got about 1 million megawatt hours of kind of firm, dependable capacity. Of that million, we probably need most of it. But the average demand nationwide, on average, is only about 350,000. So that just shows how much power surges up and down, doubling, to 700,000, and in different pockets of the country. So you need 1 million megawatt hours just to make it all work. Power, unlike oil, very tough to store. Lithium, batteries, very expensive. So that's a backdrop. Every 10,000 megs of power growth nationwide is actually still a lot of power growth because of that. So just to quote some numbers, 10,000 megs of average demand is about 1.5 B of gas. That's probably what it's going to cause in terms of consumption. So if we were to have 70,000 megs of demand, that's 7 times 1.5 B, something a little bit north of 10 Bs. I think most people are thinking that data centers and AI will probably do about 70,000 megs of new demand between now and say 2030, 2032. So it's a fairly significant piece, but it's incredibly expensive, and there's a lot of enthusiasm about it, and it's not really the same as LNG exports. So let me quote some numbers for you. We're talking about NVIDIA. NVIDIA has changed the world. They are the leader in AI chips. AI data centers are actually not all that prevalent right now today. We don't have all that many NVIDIA chips in the country. So total data centers in the country are actually only 18,000 megs today. That's growing a lot. That's probably going to double, by another 18,000 megs by 2030. NVIDIA itself, with the Blackwell chips and the revenue projections that have led to this $4 trillion market cap, NVIDIA itself is going to be producing 10 to 15,000 megawatts of chip demand every single year between now and 2030. That's an amazing number, because none of that exists right now today. Now they still have to sell all of that, and they're selling it to entities ultimately that are known as hyperscalers. People call them hyperscalers because they build really, really, really large-scale data centers. This is Microsoft, Google, Meta, Oracle. I just forgot one, but Amazon. Thank you. Those 5, and then OpenAI to some extent, is kind of a hyperscaler, are really responsible for purchasing all of these NVIDIA chips. So, do we need 50,000 megs of NVIDIA chips? Every 1,000 megs of NVIDIA-based data centers costs $30 billion. So 10,000 megs a year is $300 billion. Those hyperscalers have announced, and this is what's driving the enthusiasm, that they plan to spend $400 billion every year on data centers. And they're actually probably spending another $100 billion leasing other co-located data centers. So every other data center company you've heard of is in the game of trying to get a lease with one of these guys. So going through that math, that means that $400 to $500 billion a year must be spent to be creating this 10 or 15,000 megs of load growth. thinking about a B and a half of load growth on 10,000 megs and having that cost $300 billion, LNG itself is less than a tenth of that. That's 2 trains at an LNG project, just to put that in perspective. So this is a huge amount of capital in order to make that work. And I think it creates 2 dimensions. One, it means that they're relatively insensitive to the price of power or to the economics around the energy chain, because it's not that big of a piece of the pie when you're talking about $500 billion. But then 2, for all of us, we have to question whether it is a guarantee that there'll be $500 billion spent year in, year out on all of this. And that's the kind of the question to, is there a bubble here? It's really tough to predict what this will be used for, because it is changing the world. ChatGPT today has already changed the world and how people work. But this type of horsepower that we're throwing at it with some very amazing chips from NVIDIA are beyond anything that you would think about. This horsepower, is not to create ChatGPT 5 or to get more research. That doesn't really actually require that much power. This is to do things like train robots to actually clean your home, or to allow yourself, and this is coming probably sooner than we all think, allow yourself to make a movie with Nicole Kidman and Tom Cruise with your own plot line that you type into a prompt and you play for people at a party. That's something that that's something that could be here in 6 months with these types of chips. So anyways, I threw a lot at you, but it's important to understand that if you're looking for that 10,000 megs of growth, which is the B and a half, start by finding the $400 billion that is being spent on it.
Right.
Because without that $400 billion, it's not real. And it probably is real. But, this is going to be a bumpy road as we watch that stuff get deployed. And there has to be a revenue model to go along with that $400 billion. I'll pause there.
No, that's fantastic, because when I explain this to people or I talk about it, I have a lot of, I'm excited about it too. It's very real, except it's just that linear growth between just the molecule of nat gas that comes out of the ground to all the way to how I use this. And somebody has to make money on this. So how much am I paying to make, videos with cat videos or Nicole Kidman or whatever it is? I'm paying, I just bought ChatGPT 5. I'm not that impressed. I'm doing the $200 a month. It takes a lot, it hasn't changed my life. Helping with research, awesome. Hasn't changed my life. Writing, and I was telling Phil this earlier today. People are just saying this on Bloomberg today, that you're hearing regurgitative writing. If you want my op-eds to be AI written, then just go Google AI. You're gonna get all my grammatical errors and my thoughts, because it's not gonna get written with AI. But it feels to me like we're already increasing the demand for human interaction, and we barely got the interfacing of AI. So there's just some interesting things going on. But with that, we're gonna swing this back, because I know Sheldon probably has lots of comments to talk about on the gas side, but you're on the power side, Ron, as well. So do you want to throw anything in there? I mean, I have more questions for you directly on power generation, but I'm offering this to you to comment on anything. You look like you had some thoughts as he's talking.
No, I thought he did a great job summing it up. I think the question for us is find the dollars and then figure out how certain all of that is. Is it a bubble? Certainly, as we talk to investors about it, that's the big question is, what is your certainty around the deployment of this capital and a return on that invested capital over an extended period of time? And I think that's the thing everybody's trying to wrap their heads around now, is just how much confidence there is in how much of this gets built. It's going to be something. I don't know what the bottom is, don't know what the top is. There's going to be a range there, but I think we're trying to understand what the real numbers are and ultimately what that's going to mean for requirements in power generation. But certainly we're bullish the segment too, excited about what that's going to mean for both our core energy business, but also power generation down the road.
And I also think we can bring this a little bit more to, not more to reality, but a little more to reality, is that there is an underpinning of this bullish thesis that also does come to this reindustrialization. And I don't say that term lightly, but there is an incentive through almost every executive order and a lot of the administration's policies on the reindustrialization of the U.S. And this is coming back down to power generation and power demand. And so not just through LNG exports and increasing those, or just allowing for them in the first place under this administration, but actually having increasing power generation. And so yes, we need it for AI, but we also just need more power. And frankly, we need redundancy in power so that people have affordable and reliable power. And this is something I wanted to bring up with this panel, but Sheldon, do you want to comment anything on the nat gas side that I'm not leaving you out of this? Jump in, throw some fire if you want to.
Yeah, maybe before I touch on that, I was just going to throw out one thought on the AI. And so I think when we always look at these things, I come to the forums, and we always look at kind of our demographic as we're sitting here in the table or in the room. And one thing that I think is a little bit of a wild card, and ChatGPT is not the biggest driver of all this.
Right.
But I've got teenage sons, and I look at how they operate now versus how we operated. Obviously they don't even know what a phone book or anything that is. But like when I tell them, like when I ask them a question or say, hey, can you do this? They'll comment almost every time as well. I ChatGPT'd this, and I'm just like, so I kind of look at a little bit of analogy of like how Google was for a period of time. And so I know that's not like the ultimate driver, just ChatGPT, but I do think there's going to be a growth of things that it becomes intertwined in our daily lives that's a little bit hard to predict. And so I just thought I'd throw that
absolutely.
out there.
Absolutely. And the other thing I was going to say is just the AI is when we're thinking about China, we are thinking about cat videos and Tom Cruise videos and the things that we're talking about offline. But China's not thinking about cat videos, okay? They are actually thinking about this for robotics, and it's not robotics to clean houses. They're thinking about it for military. And so I think it's a really different game that we're talking about. And people can push back on that, but that's very factual, is what, the AI race is that we're thinking about it from how we use it and how it's gonna change our business and how on profitability and who's gonna make money and who's not gonna make money. And there are gonna be lots of winners and losers across this value chain. But in China, this isn't about profitability. I mean, most people are actually getting free power, free land, free electricity, free everything, and they're throwing everything in the kitchen sink at that. And it's pretty hard to compete with that, especially this 5,800 terawatt hours of coal-fired power generation that they can go play with AI all they want to, whereas we have to we don't just have to, we have limitations actually on the power on the upfront side.
I did want to jump in.
Absolutely, I thought that'd get you on.
Because it does remind us how important it is for our country to win the AI race, just from a military perspective, just from a national security perspective. Think about things like mosquito-sized autonomous drones that can disable ICBM missiles. That kind of thing is happening and will be here probably in less than 2 years. So it is really important for the best chips, the best NVIDIA chips, the Blackwell chips to stay in the country, and for us to use that and to be the leader in the world just for our own safety. So I think that's a key backdrop, and I do think that this current administration absolutely understands that.
Yeah, so just for perspective, the big drone strike you probably heard about over Ukraine just a couple days ago, hitting Kiev, that was about 800 missiles and drones, a barrage of them. And basically what they do is some of those drones are dummies, but they overwhelm air defenses and then they knock everything out in Ukraine so they can't respond well. And then they hit actually some government buildings. But they're already using artificial intelligence in some of those drone strikes. And the key underpinning of all this is power is what's doing this, right? Ukraine needs power generation to actually make these drones. And this is where this is so intertwined in the work that I do on the national security side, but it really does come back down to like our energy dominance. And I think we've heard this a little bit and people have not paid it quite the credence we need to give it to, is that the energy dominance agenda that this administration also has, it's really quite serious. And we are dominant, but we need to kind of lean into that. This is why I think the power thing is so interesting, is that we have a ton of natural gas power generation, but yet we don't have cheap electricity prices, and we should. And yet we have people who need power and they don't. And yet we have people in the field who need power and they don't. This is why Liberty and other companies have mobile power solutions, because we can't get the utility companies to hook it up. So we have this kind of disconnect in everything. Is this feeding through on, maybe you can talk to us or can't on a public side, is this feeding through on investment thesis that this is needed and we need all this? I hear a little bit in your earnings call when people ask, but like we know we need this, so this is driving some of these mobile power solutions, and also the investment thesis that you can talk to us on the P side, but that you guys have been talking more about having that exposure on nat gas. And that we've seen the rig count flip where we had 20 rigs. Oh, by the way, did anyone have that in their bingo card, that we had 20 rigs flipping from oil to nat gas? I thought that was pretty cool. Sorry, so maybe Sheldon, and then you can flip over to you.
Yeah, so I think your question about is this translating to the investment thesis, I think it absolutely is. If you think, you talked about cleaner and affordable and reliable energy, I think that's where natural gas really comes into play. And so, if you look at kind of historically, natural gas in the past was kind of a little bit of a byproduct of oil production. That's what everybody focused on. But I think because of the things we were talking about, LNG, AI, power demand, it's flipped around. And so I touched on earlier a little bit around the productivity of wells, and so we've gotten really good at getting gas out of the ground in the U.S., and that's been part of that energy dominance. But as you see those plays mature, I think that cost curve goes a little bit higher, and so we used to talk about this when I was up in OKC. It's like we could probably drill a well on the Chesapeake campus and get gas out of the ground, but can you get it out cheap enough? And so I think a lot of people we're kind of looking in the near term saying, hey, prices are going to go up and the costs are going to go up to produce it. But I think when you get to that next tranche, if you get that kind of $3 to $4.50 gas, then it gives you that investment confidence to go and draw that next tranche of plays. And so I think they'll see that switch in the U.S. to where you're going to those tier 2 plays, and then I think that also turns on more investment in the international market. And so I think that's the one thing that's probably the flip side of the increasing price story is that there's a lot of gas in the world, and so I think if you can get that to the right places for a reasonable transportation cost, then I think that can help keep the prices low enough where it's going to continue to be a key component of power gen and all these other things besides just what it's been in the past, which was kind of a byproduct.
Yeah. Ron, do you want to grab that? And I know you have many thoughts on this.
Lots of thoughts on power generation.
And the gas flipping.
And I'll start on the power generation side of things. Certainly from an investment thesis standpoint, that's what most people talk about today. I've spent probably more time than average in front of the investment community over the last little while. And of course, our core business is oil field services. We are a frac and wireline company. We don't earn a dollar from power generation yet today. But typically in an investment meeting now, 25 minutes on power gen and 5 minutes on the core frac business. That's where the interest is. And you've seen that from the companies that have already made that move. Companies like Solaris have seen a dramatic change in their multiple and valuation of their company as a result of a step into power generation in a relatively small way compared to the scale of the market. But I think what people have recognized is that there's a real opportunity for the ingenuity, expertise, nimbleness from oil and gas to make a real dent in the power generation needs outside of oil and gas. We run power generation today to power our electric frac fleets. And so we have a power plant for each of those frac fleets, and it drives someplace and it runs there for 30 or 45 days, and then it packs up and moves someplace else. We've gotten really, really good at small modular power. And so the idea that we could take that same expertise and put that in a place where we don't have to move it every 30 or 45 days and then build it at a slightly different scale has become quite appealing. We have the ability to package those assets. We have a supply chain to support that. We already have a North American-wide service platform to service those engines. And so it's not a huge step to see moving into power generation. And so we've made the very conscious decision to do that. We've ordered our first 400 plus megawatts of power generation to start deploying. And I think you're starting to see the hyperscalers come around to that idea. It used to be the belief that the grid was absolutely the holy grail for connecting your data center, and now I think there's a recognition that while the grid is a great thing to be connected to in the event where that doesn't make sense from a timing standpoint, behind the meter power solution could be very, very compelling. And so we're having an immense number of conversations, gigawatts worth of sales pipeline around that exact idea that you would build a behind the meter power plant that allows them quicker time to market and then ultimately certainty around their power price. Once you have a behind the meter power plant built, we don't have to support additional grid infrastructure or anything like that. Our power price is effectively the cost of the fuel plus the cost of the maintenance of the power plant. And it's fixed like that in perpetuity. So to the extent you can gain certainty on the price of a molecule of gas that's feeding into that power plant, you have the ability to provide to the end user a guaranteed power price for a long, long time into the future, which is not necessarily something you get from the grid. And so we're starting to see a lot of interest in that. Ultimately, when the grid arrives, there's some very interesting commercial opportunities there. You can imagine a day where it's quite windy outside and the sun is shining and we have abundant power on the grid. Power prices in a deregulated market are quite depressed, that the end user could take advantage of that we could shut down the power plant, draw power off the grid, and run the data center off that. And on the flip side, to the extent we had excess power available and the grid was in a situation where there was incremental demand, that we could provide that power back the other way. So I think ultimately it's going to evolve the way the grid works. I'm sure Andrew probably a little more up to speed on this than I am. Certainly we're newer in that world, but I think we see a very interesting commercial solution that involves a lot more distributed power generation in our world than has historically been there. So pretty excited about that and ultimately what that means for the gas side of the business, we've been through the numbers. It's probably 5 to 7 BCF a day of gas, and the nice thing about that is it's relatively weather independent. The load is there day in and day out, and so it's a relatively consistent usage of gas. I love the LNG export thing, but I'm a little fearful we're going to be long LNG in the world for a bit of time, and the challenge with gas is it's hard to store, and so to the extent we don't have a destination for a cargo and we shut down an LNG train, that backs all the way up to a wellhead. We have to shut in gas supply for that. And so I do think we're going to see a bit more volatility in our gas market as a result of being a major participant in LNG. I think the benefits still far outweigh the challenges there, but you can really see the benefit to the gas producers as they think about finding partners in this AI space as a very, very long-term, consistent customer for gas that is there day in and day out, winter, summer, doesn't matter what the weather is. And so excited to see those partnerships continue to grow and flourish.
Excellent. Well, you've opened up a bunch of different topics, and I'm gonna have you jump in just a second on this power side. Can you hone in a little bit on this? Because there's a few segues I want to get on. We can talk about LNG and nat gas in a minute, but can you hone in on this reliability piece?
Yeah.
Because you'll never hear me say the word cleaner, and it is cleaner. But can you hone in the actual reliability of the grid piece, as well as his comments on the offshore? Like I know you have several thoughts here, so run with it, and I might ask you a few more detailed questions in that.
Yeah, no, I do want to. Let me talk about that and agree with a lot, and then also give maybe a different perspective that may ring a little, that may sound a little different. So let me start with just one thing that I do think that people who buy and sell power know this, but most of the country, as they've wanted to get expertise in power, this is surprising. And this is the fact that for grid-connected power, if you can have a load that connects to the grid, there is a huge abundance of electricity almost all the time, except for somewhere between 50 and 200 hours. And so that is a concept that I think doesn't exist in oil, where everything is storable, and it definitely doesn't exist in natural gas, less storable, but not to the extent of electricity. So just to say that one more time, all of the scarcity value is in less than 200 hours. Many people would say only 50 hours. In years like this, less than that in states like Texas, almost no scarcity in the summer. And so that really means a couple things. One, you need to have those 200 hours of power, and that's what people pay for grid-connected power. I'll come back to non-grid connected in a second. It means that if you're going to enter the electricity business, and it's awesome right now that so many people in oil and gas want to enter the electricity business because this load growth needs to be served with new capital and new entities coming in. We're seeing that. But if you do, you have to very quickly kind of join up and get to be a deep expert in the GovReg policy that ensures that you get paid over the course of a year for the fact that only 50 to 200 hours have any real value by having that steel in the ground. All the rest of it can just be served by tons of excess. And that's because of the concept I mentioned earlier, which is our average demand is 350,000 megawatts. We've got 1 million megawatts on the grid. There's a lot of stuff for a lot of other time. We can bring on 70,000 megs of data centers. If they stayed off for 200 hours, no problem. You don't need to build another single power plant. If you get them to build recip engines and use that for 200 hours, also no problem. And so that's the first concept that I think kind of blows people's minds. The second concept that has also caused a lot of excitement in this is that so much of this demand hooking up cannot get transmission in any kind of timely way. So in the Permian, you are seeing, you can have a set of mobile recip engines and get rents that are double the price of grid-connected power. So I just want to throw that out. In West Texas today, grid-connected power costs about half of what it does if you were to go rent a recip engine or do a lease on a recip engine for 4 years, let's say. And that is because it is taking so long for utilities, regulated utilities, to get the infrastructure that they need to hook up that demand. And so there's a lot of value. There's also value of just being behind the meter because transmission itself is so expensive. The total rate, this is the best example I give is in California. The wholesale price may be 8 cents a kilowatt hour, but the total retail rate, if you didn't get behind the meter, can be as much as 45 cents a kilowatt hour. So
which is the price in Germany, by the way. So that's a problem.
And that's for a whole host of reasons. It's not just transmission, but that's a huge piece of it. But that means that doing a mobile recip strategy in different states and being able to provide power behind the meter if you can regulatorily, like you can in West Texas, you can save a tremendous amount of money. So those two are kind of a starting point, to understand. Tons of excess power outside of 200 hours, and then very, very hard time getting grid connected. So we recently, in the last month, announced, super proud, actually, Rick Pena, who's in the back, did this deal for Calpine. It was one of the first gas-adjacent, hyperscaler-backed long-term deals with CyrusOne as a partner. We're hoping, we expect it to expand here sometime in the next month, and we're busy doing this with other sites in Texas. What we found there is that for that hyperscaler, as well as the other four, they do want the best of both worlds: grid connected and backup engines, the ability to be behind the meter when they want to be behind the meter. Now, on the flip side, huge debate: are you willing to curtail your load during 50 to 200 hours? A little bit easier if running recip engines counts. And that is a huge strategy of theirs, but it's not something people love. It's something that they're willing to do now in order to get their data centers online, and it's something they're willing to do because they've now recognized the importance of this for the country. But as these NVIDIA chips go to other entities, go away from the 5 hyperscalers to entities like CoreWeave. CoreWeave is kind of an entity that's basically, it's like buying a car and leasing it. They're leasing out Blackwell chips for 5 years. Other companies like IREN that are taking Bitcoin miners and replacing them with NVIDIA chips. As you start to bring all of these things online, and you bring in the fact that for most of the year there's an abundance of power, you're actually going to get to a marginal price of compute on the grid at different times, or at least a very low price of compute, except for, say, the top 5% of the average.
So let's bring this to price, because this you're getting into price and reliability. So this is the trouble I have right now, and I brought this up to you. So this is your curveball. We have very expensive electricity prices in the U.S. We had a decade of flat electricity prices. So I love hearing that we have enough power and we have this, but the problem is electricity prices, they look like this. And for the first time, we actually have more wind and solar in the U.S. grid than we have coal-fired power generation. We haven't moved much on nuclear. It's pretty flat. We haven't really grown it. We've decommissioned a lot of coal, and we've added a lot of wind and solar. And I'd argue that's a big part of the price increases. But it's hard for everyone to hear, hey, we have all this natural gas, and we're super bullish natural gas, and don't worry, we're coming back to you on nat gas. We got all this natural gas, but we have a problem with electricity prices in the U.S. So can you just explain that a little bit? If we're actually short, what the hell is going on with price? Because it seems to me like the utility companies are making a crap ton of money.
Yeah, let me go back to the first thing that I said. We have a ton of power outside of 200 hours. Those 200 hours matter a lot. I'll use a state like Texas, which does a great job of pricing every single hour. In Texas, you can have 10 hours at $5,000 a megawatt hour, and then every other hour of the year will be $25. And so just put that in your heads. That's how different that is. Those 10 hours pay for your entire power plant for the year. Now, in terms of whether companies lock that in, we spend a tremendous amount of time as Calpine, as do our competitors, offering any product that any consumer would want in terms of fixing in price. They either do that through long-term fixed price deals. We'll do 10 years of fixed price, base load deals. So all of that infrastructure is there. We can do options, we can do anything. And we team up, including with oil and gas companies, for their electricity loads that are grid connected, to give you whatever kind of pricing you want. So you can lock that price in through us. But even if you're locking in that average price and you're not exposed to that difference, your price is high because for us, we're insuring you against those 10 hours at $5,000. And so that all comes in, and that's a huge part of it. But when we go back to, and California is to some extent an unfair example. Texas is nothing like this, given the policies in place. But the actual retail price of power frequently is double the price of wholesale power across the country. And the reason why it's double is partly policy that makes its way into the rate, but then also transmission. For wind and solar, when you think about the cost of that, most people understand, well, it's intermittent, and therefore you need to have firm units. And because it's intermittent, you've got these $5,000 hours for 10 or 15 hours. That makes you have to have a curve that's pinned to the new build cost of gas. But there's a hidden cost to wind and solar that's way beyond that. Wind and solar is not energy dense, and therefore requires a tremendous amount of transmission to be built. The more wind and solar you build, the more transmission you build, the more that rate goes up, and the more out of whack the retail price gets from the wholesale price. If we had no wind and solar, wholesale prices would probably be 2/3 or 75% of the total cost. And so that is a really tricky thing to figure out, but very dense, a very dense energy that is located, that doesn't require transmission, has a huge benefit to the grid because it saves money. It's one of the reasons why your company and now Secretary Chris Wright has been so supportive of the idea of modular reactors, at the location that they are, because they understand that energy density is a huge win for the ultimate consumer.
And power density, it actually doesn't seem that hard to figure out to me. It feels like we already got the answer. But I'm going to loop in, and no, I'm not shredding you for being a company, just shredding wind and solar. Okay, Sheldon, this gets to a really good point, and this is something I like to point out to folks, is that the price between what we get for natural gas, and I think you can hone in on this a little bit, $3 an MCF, it is exciting, and it's kind of amazing that that's exciting, and it's probably really exciting because on the back of 2024, we had $2 an MCF. But that is not what the consumer paid. That's not what the residential, the utility payer is paying, or what we were charged by the utility companies. Sometimes as high as $26 an MCF. But I think it was average in 2024, it was like 18 versus $2 an MCF. Massive margin, massive gap. And that keeps widening. So, we're not getting that pass-through or that savings, but you're on the PE side, and you're thinking about nat gas. You're obviously in oil as well. Do you have any, you probably have a lot of thoughts on this stuff, but is that enough to translate to say, okay, well, even if we don't get that price growth, because I think a lot actually works at 3, I think a lot works at 350, a ton works at 4. But does this keep you more excited or a little hesitant of what Ron was saying, a little bit hesitant on the LNG side, and we need that power growth?
Yeah, I think overall it still keeps us confident and excited with what's coming. I think because of some of the things I touched on earlier, the productivity that we're getting, we're drawing longer laterals, getting more efficient. So I think there's a lot of tailwinds there. I think the concern is if you get to the point where you get those high prices for longer times. When you have those big spikes, like you said.
Power story?
Yeah, we need some. It's the grid.
If only they had behind the meter power.
That's right. If only they had a natural gas generator on. So you mentioned there's those big spikes, and similar to what Andrew was talking about on there's those spikes in electricity prices. You have some of the same dynamics in natural gas. When you get those peak times in wintertime or when there's those peak demand days, you have that, but we can't bank on that as an investment thesis.
Right.
And so I think ultimately if it's that kind of 3 and above with what we're seeing now, there's a lot of things that we can do on a lot of the basins. Appalachia is well below that. They're a bit constrained because there's just not the pipes to get out of there. I think Haynesville is still the one that we're continuing to be most focused on. We got a long history there because I think you got a little bit higher break evens in that 250 to 3, but you also have access to the LNG markets where you can get it to those times when you get a much better price. So I think one thing that's shifted probably in the last couple of years is historically we all just said, okay, we're going to go drill and complete and turn wells on and just kind of take whatever price we get. One of the things that's become a lot more common now is, your biggest cost is your drill and complete. It's not as much cost to bring those wells online. So there's been a lot of investment in drill and complete wells and let them sit. And when you look at the economics, turning those on in those higher price environment, you can actually let that investment sit there for even 6 months, maybe even a year at times. And so you've seen that that's been a big driver for why you saw Haynesville have that big ramp up in growth.
So they're not ducks. I love this because this is what I advocate for the industry to do: is drill and complete. Just don't produce it yet.
Yeah.
Which is what everybody should have done during COVID. So, but you're seeing that. You're saying you're actually seeing that in the Haynesville now.
Yeah, we're seeing that a lot more now.
Yeah.
So deferred turn lines, or so I think that's something that. Just like you're talking about, you really want to take advantage of those 50 to 200 hours. You want to take advantage of those days when you really see those higher prices. Once you turn that well on, there's a lot of risk in shutting it back off and turn it back on all the time. But you can have some control over when you turn it on and get those peak rates.
So we've been talking about power. We certainly didn't spend enough time on power and AI, but I want to bring this back to oil and shale and peak shale. This is a big one, you guys, obviously, I'm going to give you a chance to say everything that we've sort of missed, but Ron and Sheldon can talk about this. Ron, you and I have bantered quite a bit about peak shale, but I have a hard time with it. And I've said this is because people think of it as a peak, like literally a mountain peak and then a decline. And I think it connotates the wrong thing. I have a lot to push back on peak shale, but I'm going to throw it to you guys. You've been talking about production. I mean, Ron, you're actually completing these wells. You're talking more about the power side lately, but you're obviously, you guys are the second largest frac company in North America. You know this well. What are your thoughts on peak shale? Are we peaking? Are we rolling over?
Only if that's what price signals suggest. I think to the extent there was a price signal that indicated we need to go out and drill for more oil, we're gonna do that. Every one of the businesses we work for is in this to make money. None of them are charities. And so in an environment where oil is maybe in the $60 to $75 range, we probably see production hold relatively flat. I don't think it's going to fall. I've said here already, I'm of the opinion that our customers are not prepared to cede meaningful market share to the Middle East. I do think we will aim to hold on at something close to 13.5 million barrels a day. And I think we could do that for a long, long time to come. I certainly have no concerns about that. Were we to find ourselves in a situation where down the road a few years, maybe the back part of this decade, we have a supply-demand imbalance the other way, where we have demand that has exceeded our ability to catch up from a supply standpoint. And certainly there are some people out there who have that perception. We haven't been investing a ton of dollars in exploration. We know where the growth is coming from for the next few years. We have offshore Africa, Guyana, and a little bit of production from some other places that will fill that gap today, along with the OPEC plus production coming back. But you get out to the back part of this decade, and I don't think it's an absolute given where those incremental barrels will come from, assuming we maintain a % a year growth or something like that. And so there is a scenario where you could see oil push up to $95 or $100 a barrel. That's a price signal. If you're a private operator, for sure, in North America, you are absolutely going to respond to $95. You're going to stand up rigs and you're going to start completing wells. I don't think there's a lack of inventory to do that. And so I'm absolutely confident if we saw the opportunity to do so, we would grow production beyond where we sit today. So I'm certainly not in the we're rolling over camp. At worst case, it's a plateau for an extended period of time.
That's why I call it plateau shale, which doesn't sound as sexy, by the way. Butte shale, plateau shale, that's not as cool.
Yeah, and certainly I think, I like to think of our world as North America, and so absolutely that ability exists north of the 49th parallel too. We have a country to our north that could bring on another 3 or 4 or 5 million barrels a day without too much trouble.
And so, are you in the thinking of? And you can hand it to him, but are you in the thinking that 60? You said 60 to 75, which I would say from an industry perspective, and I'm with you. I actually think that if we were to go to 68 and stay there, I think people are going to feel awesome because they kind of feel beaten at 62, and I think 68 would feel amazing. And I think people aren't realizing that we could do a lot at $70 a barrel.
So I think you have to be a little bit careful about that. I think that our customers might feel amazing at $68. I'm not sure that brings activity back to a level where the service companies feel amazing. And so
you need to feel amazing.
We have to feel amazing too. If we're going to grow production, you have to bring back rigs and you have to bring back frac crews. We have to be able to hire people to do that. I need to feel amazing before that's going to happen. So so I'm cautious at 68. I'm not sure that's a price signal that gets everybody to that spot.
That's fair. Okay.
Yeah, I have probably a similar opinion, and kind of I like to look back at history, and so you think there was we've been through this before, where it's like, oh, we're at peak oil, we're at peak this, peak that, and what I've seen over time and time again in our industry is we always find a way to go and find that next barrel, and so I think right now it's just been because those prices are lower, there's just not that confidence to go and make that investment, and you also had this big swing. We went from a swing of everybody being kind of growth incentivized to capital discipline is the name of the game, and so I think that's what's kind of hampered some of that activity. But I think there's the best place to find oil and gas is where you've already found it, and so I think there's a lot of additional inventory there. It's just you got to have that price there and the confidence to go and get that. And so I think about when I was first kind of out of college. Permian was having had its day, and it was like, oh well, the Permian's on the decline, and so. Went to other basins, went overseas for a while, and then you look at 10 or 20 years later, and we're back, and all those reservoirs that used to be, source rock or like, tier 2 or 3 or 4, like we're all completing those now, and so I still think there's more reservoirs like that out there. And I also think, the thing that we also overlook is, how many million wells that have been drilled, and because it's been easier and a lot more cost efficient to go drill that next well, we've kind of taken our eye off the ball a bit on kind of that base blocking and tackling work on managing your production and going back to some of the old CO2 injection and enhanced oil recovery. So I'm not saying that's going to happen right soon, but I think that there's always those things that it can kind of cycle back around the next decade or so, where when those barrels are high enough priced to incentivize that, then I think we go back in and we have the technology and the know-how to go and find that next barrel.
Ron?
I was just going to say, if you want to think about a real economic opportunity for AI, we've not really gotten anywhere in terms of moving recovery out of unconventional reservoirs. We're at 8 or 9 or maybe 10% or something like that. If you think about a massive economic opportunity and something that potentially AI, with its ability to look at the huge data set we have in unconventional now, could unlock, maybe it's the ability to double that to 20%. And you can imagine what the economics look like on an unconventional oil well if we could double recovery out of it. It would be phenomenal.
That's a really good point. And we can loop it back to both. I know you want to jump in?
Well, I was going to say, look, for the wholesale price of power, fixed power prices, there's nothing more important than that question. We're going to need another 15 to 20 BCF of extra production by the end of the decade. And if there's peak shale on gas, that is a problem. So far, this administration's been incredibly helpful and favorable to getting new pipelines on and infrastructure. So from our standpoint, it feels like, of course, it should be easy to do another 15 to 20 Bs, but occasionally I'll get a report from, let's call it a gas trading analyst that are constantly measuring, we're down on production per lateral foot drilled, and I'm not an expert on that. You guys in this room are an expert. If that's happening, if it's rolling over, then that is very bullish fixed price for all of this, and it's going to matter. I'm personally skeptical that it will, and I think we can do 15 to 20. But
there are whole basins in Canada with not even a rig in them today. So I'm not worried about producing an extra 15 to 20 BCF a day of gas. And I say bring it on.
Or in the U.S. And I would say, so I would just rip into the data, and this is what's really hard I think it's hard for folks within the industry, is actually to figure out why are we still at 13.6 million barrels per day when we've actually pulled back in activity. And when you look at this, it's these, looking at Cord drilling a 17,000 foot lateral on average in the Bakken. Everybody's like, it's not exciting, it's not sexy. Well, it actually kind of is. There's private equity, and this is with the private equity interests and stuff. And this is where I think, also you just mentioned tier 3 and tier 4, which I love talking about that, because I think it's companies like Ron's that is really, they've taken that tier 3 and tier 4 and turned it into tier 2. And folks have taken tier 2 and turned it into tier 1. Now it's not because it's gonna take the work, and that's why he has to feel good and the private equity. Everybody has to feel good. But I think the role of private companies and private equity is huge. And we have to keep that in mind. We don't do a good job in Colorado about enabling small companies to do things. We basically have 2 big ones left. But I just think it's really important. The role of the service sector is huge. The role of the private companies is huge. And obviously the power side is very, very huge. But you guys I feel like you might want to jump in and say something too.
I was only going to say that, the efficiency story is amazing. If you think back to when we started Liberty, late 2011, early 2012, there were 450 frac crews running to support what was, at the time, I don't even know what production was then, 7, 8 million barrels a day, 9 million barrels a day, I don't know. And now we're down to 175 frac crews supporting 13.5 million barrels a day and 106 BCF a day of gas. So we measure it in tons of sand pumped per Liberty employee. And the graph is dramatic. If you look at where we started with a 12-hour crew and how much sand that team of people could put away versus what our employee base puts away today, it's astronomical, the efficiencies that we've been able to find as an industry, and it's no different on the drilling side. It truly is remarkable.
Yeah, no, it's really incredible. So the comments that you hear on the power side, I think that's important to note. It's just that this feedback loop, and I'm blessed that I get to spend a lot of time with very different folks across the value chain of our industries. And not everybody has the same information. So the power guys don't always have the exact information of, I'm pumping 3,000 pounds of sand per lateral foot. I'm pretty confident it's giving me this. I'm looking at the decline curve. Yes, we can do this. And I say this from a market intelligence standpoint, it's pretty important that we start closing the gaps on these things just from an investability standpoint. And as exciting as it is to have an administration that is pro-energy and energy dominance, that has not completely fed back into the stock market, right? And part of why $62 a barrel, it is oversold. It's not actually where we probably should be. But with that, I'm going to open this up to the audience now and let you guys have at it.
Somebody's got to go first.
Over there? Yep, hands up.
Yeah. So my question is about power generation, and we talked a lot about the AI and how natural gas is going to be a huge part of powering these plants. My question is, on the side of these chips, right? We talked about NVIDIA, and how they're doing a great job with generating AI chips. But each generation that they come out with on new chips is probably going to be more and more efficient. So I'm curious how that efficiency is going to change the formula for the long-term look of natural gas.
Yeah, so they have been more efficient. They've actually been especially more efficient on the inference side. But one of the trends that we're seeing is that calculations, and sometimes they call them flops, per megawatt, that is starting to slow down on efficiency. So some of the most recent versions, the Blackwell chip going to a GB200, which is the next version, or a GB300, is not actually getting great gains of calculation relative to the megawatt hours used for it. It's getting great gains in calculation power and the ability to do something very, very quickly, but that part is slowing down. That being said, where I think that the real efficiency gains come in is how you use these models. The difference between, say, a super optimized GPT that uses what they call a mixture of experts model, and this is kind of what the DeepSeek crash was all about, where you're able to make different pieces of the model handle different aspects, cut the power usage for inference in that by cut it in a tenth of what it ordinarily would be or more. So there are a lot of gains in how people use this stuff that can cause even greater efficiencies than we can imagine. But then people are also trying to use that capability to come up with other crazy stuff.
I would say philosophically to that, I can't think of an example sitting up here where increased efficiency has ever led to reduced use of something. In every case, we've gotten more efficient and we've just spent more money doing it. So whether that's fuel efficiency in a car or light bulbs or whatever the case, we always end up using the excess energy for something. So I don't see it flattening out power demand. My guess is if we build all of this and we get more efficient at it, we'll find ways to use the compute power.
Right. I was going to add a simple example of that. That's how I think about it is, when LED lights were first coming out, it was like, oh man, these are going to reduce usage so much. And then now look, and I've got like 50 of them in my ceiling instead of just the one light bulb I had before. So as they become more efficient and cheaper, then we use them a lot more, and it ultimately improves your life. So I think it could be a similar trend. Very simplistic, but that's how I explain it to my kids. So.
And it's a great question because it does make you think though about that linearity and the investment thesis and how that works. And you're starting to hear people talk about that efficiency, and then do we use it? And I think we already have a problem in the U.S. where we don't have enough redundant power generation, right? We in this country with 130 billion cubic feet per day of gross withdrawals of natural gas production, we also have more coal in the ground than any nation on earth. We have zero excuse to have electricity prices we do, and zero excuse to have any kind of energy poverty, and yet we do. And so we should be, starting basis there, but in terms of the stuff we have to build, the ships we have to build, the actual, just basic reindustrialization to make things, I think that this is gonna play well nicely into this, but it's a great question on this investment thesis and good answers. Next up.
Do you see producers making long-term sales contracts to AI generators, and/or do you see producers vertically integrating into power?
Great question.
Yeah, so I'll answer the second one first. I think we are, if you think about the historical, again, from a producer side or operator side, it used to all be about, hey, we're going to go and drill and produce wells, and then it became we're going to drill and produce wells. We're also going to think about gathering systems and midstream. You started integrating there. And then I think now that we are starting to look at, hey, do we do some of the distributed power models? And so I think it's going to continue to kind of leapfrog. I think we're not quite there yet. I mean, you have a few big producers that are kind of starting to, lean into that a bit. And I think because the AI is so reliant on 100% of power available all the time, that's where I think that's what natural gas kind of brings to the table. As long as you've got the reservoir and the runway where you can go drill those wells, that it brings that. Even if you're connected to the grid, it brings that confidence for that AI or that data center. Because once those if those things ever have a blip, then you're done on those calculations, and so it really needs that there all the time. So I think it's starting to get there. I do think that's going to be a trend that continues. And I know, just thinking even about Quantum, our backer, they've started to move into some, they've made some investments in the power side, and they're really heavily looking into the AI side.
One of the public partnerships we've announced is a partnership with Range Resources. So they've identified land. They've got a land developer on board. We're partnered with them on power generation. So us and Range together are going to provide the means to generate electricity for a hyperscaler that ultimately builds in the Northeast adjacent to Range's acreage position. So they are looking for long-term homes for that gas, and as mentioned, we're takeaway capacity restricted out of that basin, and so the best case is that we actually get to use it there. Find a good end use for the gas, and encourage them to build right adjacent to your wells, and problem solved.
Tons of E&P companies getting into power.
I mean, you saw EQT sign up with when they announced that Carnegie Mellon thing, very similar thing with the 1 BCF a day. And this actually gets into a little bit of this thinking on the LNG, I think. I'm a little more bullish on the LNG just because at 50, we're only moving 53 billion cubic feet per day on water globally. And we're talking about the demand here just on this panel for AI. There are other countries that want some of that. And if they had the power generation, they would be able to do a little bit more, but they need that power. And so I think you got to build the infrastructure, but there's optimism there. Next question. That was really good. Yep.
Piggybacking off that, do you see the AI companies getting into E&P?
No. Look, in terms of the 5 hyperscalers, they are very reluctant to really put their name on something that's not carbon free. So that's why you've seen great enthusiasm for them to do firm 24/7, 20-year nuclear deals for that reason. How do you have reliable power that doesn't have gas? Now, all right, you may.
So I'm going to take exception to that, because I think they were in that case, and now they have started to say quite publicly, we recognize that our aspirations around net zero operations of a data center are completely unrealistic. And so I think they are actually about to become, and I would argue already have become, oil and gas's best friends. They know where the power is going to come from. They know who they need to be talking to encourage that development, to support that development. And so I think you're seeing a much more open conversation between them, with the ask that we maybe have a plan to get there. So, for us, that's a partnership with Oklo, the idea that you could bring small modular nuclear to the table when that ultimately becomes commercial. So they want to understand that, but and maybe Andrew can talk to this a bit better, but I don't think nuclear is the right solution to provide 100% of the power for a data center. If you look at the load swings on a data center, it could be as much as 50% of the total load in a fraction of a second. That's not something nuclear responds very well to. As base load capacity for that data center, absolutely. But then paired with high frequency response natural gas, batteries, and ultimately supercapacitors probably to navigate that really high frequency stuff, I think you come with a pretty compelling solution. And so what we're starting to hear from the hyperscalers now is that we're 100% comfortable starting with 100% natural gas. In some cases, we would like you to have a path to baseload power that reduces our overall carbon intensity, but that we recognize gas is likely to be a part of our commercial solution for decades to come. I'm not hearing pushback around a 15 or 20-year power purchase agreement with a behind-the-meter power plant fueled by gas.
Okay, well, let me just clarify a couple things here. There's a difference between equity ownership in oil and gas wells, or even equity ownership in a fossil power plant, versus doing a contract. And then there's another big difference between doing a 15-year contract with a fossil fuel power plant and letting the name Google go out there as a press release on that contract. So I think it's interesting to go Google the different deals that have happened that Google's put their name on. And there are, as you can see, including from Calpine, gas-adjacent hyperscaler deals, but I haven't seen one yet where they've put their name on that, even though they recognize that they are consuming fossil fuels.
And they're very much in the, I think this is to Ron's point, they've recognized that they have to be a part of it because they won't get the power, and everything is reliant on this power. So if they need to, and if this is tech, let's be honest, they will sell their souls if they have to. And so they don't care, like ESG is all BS anyway. So they're gonna go out and they're gonna get the power. And natural gas is a good, reliable, energy efficient power. And on the power density side, natural gas is 1,000 times that of wind. So yes, the tech guys are mechanical engineers and have figured out that they'll go for nat gas. And eventually, if the winds shift enough on politics, I think they'd put their name behind it.
I think you're going to see that later this year.
Yeah. Sorry, wasn't trying to crush you there, Andrew.
You're not going to see Microsoft say ESG is bullshit.
Yeah, I'll do it for him. It's fine. Yep. Questions back there?
Hi, Petra. I'm from Midland, so I see all the flares, and I have a real application question to ask you. So I know who needs power and who has too much power, too much gas, and what to do with it, looking for off-takers. And a regulatory roadblock I find into is maybe the operator has too much gas and they're sending volume to a disposal or treatment facility. A treatment facility or disposal, they're 2 years out before utility power. So the cost of running at disposal is driving the cost of the rate that they're taking that volume. Because of those roadblocks, the regulatory roadblocks, oftentimes, of course, that E&P would love to sell power to that disposal to reduce their rate. My question is, are those conversations happening? Is that possible? Is that even on the table? Are they able to work around that behind the meter to sell power to someone that's taking their volume or to a neighbor? Because a lot of times, up and down 285, I've got one customer here that needs power, they're 2 years out, you're gonna have to do on-site generation. I've got a customer on the other side that has too much power, and the midstream company obviously will never admit they can't take all that volume. But we see the flares, we've seen them, they're there, and there's excess power. How do we deal and how do we make everybody kind of kumbaya on that?
Yeah, so I'm gonna let Ron, we talked about this a little bit in the podcast, and we've talked about in terms of like, can you take the field? Yes. You probably have a comment on this. I'm happy to throw in. It doesn't seem like it's completely there, but Ron, do you want to take a stab at it?
So I would say there's an opportunity to do that, and I'll give you an example of how we're approaching that. So we are very fortunate to have at one of our sand mines a substation that has capacity beyond what our need is there. So our need at the mine is about 3 megawatts. The substation that we are co-located with has capacity for about 18 megawatts. And so we have the ability to set ourselves up with behind the meter power generation there, but ultimately generate power in excess of our own needs. And then we enter into a virtual power agreement with that load that we're not immediately adjacent to, but is somewhere connected to the grid. And the power that we're generating, well, those electrons may not be the exact ones that end up down there, are the ones that we're selling them. So we're in a position of being a power provider on a very small scale, but happening down in the Permian Basin literally as we speak. So I think I've got the fundamentals right on how that agreement would work, but yeah, we're
like a public utility or a private line?
No, so it's on the public line. So right now our mine is fed by ERCOT. We're on the grid. But as we've entered into power generation, and because we're blessed with this opportunity where our substation was meaningfully larger than our need there, in other words, we're able to put generation there where we provide our 3 megawatts of power and then could provide 15 megawatts to the grid. We now have 15 megawatts available to sell via a power purchase agreement to some other user in the area. And so if you're wanting a disposal well down the road there and you need some power, we have the ability to sign a contract with you for some portion of that or all of that 15 megawatts carried by public transmission to get there.
But
Liberty that does it, or is the E&P that holds that?
Well, in this case, it's Liberty, but that's just an example of how that model could work. There are a number of E&Ps who own their own microgrids. They have their own power generation facility central to their operating area. And to the extent they have a connection to the grid that allows them to generate and ultimately provide power onto the grid beyond their own needs, they would be in a position to be able to sell that power via a virtual power purchase agreement to somebody else in that area. So I think the market premise is there for that.
But you're really talking though about when you see a flare, and it's not. I mean, so he's 100% right that this is growing, but you're seeing flares and you're saying they're not using this gas. But I mean, most, like in North Dakota, for example, almost all of those wells that flare are connected to a pipeline. So it's not that they're not connected, it's that you peak and then you decline, and you do have to flare some of that. And that not everyone is, we have to develop infrastructure. And the single biggest thing I'd say to any regulators or anybody in DC is that when you think nat gas, think building things, right? Think transmission, think compression. And you still have to build all this stuff. So everybody has to get together, and so the E&P would have to be pulling this in and taking in that field gas, right? And then doing all this. And so there's hundreds and hundreds of private operators where they're not flaring. I mean, they're flaring this for kicks and giggles. They have the pipeline, they have the infrastructure, but they haven't put all this stuff together. Would you agree with that?
Yeah, I think the problem is recognized. I don't know that the regulations or maybe even some of the investment is kind of kept up to get the infrastructure there. And I think in the Permian in particular, every time there's a new line that comes on that gets gas out of the basin, it's filled immediately. Yeah. So there just needs to be additional investment and additional pipelines to get it out. And that's been I think one of the big issues, like you said, is just the length of time it takes to get those approved and get them constructed. I do think there are some near term and quicker solutions, like this localized power, and we've in the past have had companies where we did that ourselves as well. There's even some of those times where you go and generate cryptocurrency, or there's all kinds of other things, and that wasn't real popular for a while either. But there are some things that are out there. They're just one, the regulations need to catch up, and then two, that investment thesis needs to be there for a long enough time to encourage it to get done.
I was only going to add, look, I think what we've discovered is it's much cheaper to put fiber in and much faster to do that than it is to build a gas pipeline. And so I think you're going to see data centers go where the gas is, not the other way around. And
that's just my point, Henry. You have got to build pipelines. And it's not the sexiest thing in the world to say, but you have to, oil plays don't work when you don't have enough pipeline capacity. You have to have redundancy in pipeline capacity, and we've got to get on board with realizing this with natural gas, but you have to have redundancy in pipeline capacity out of North Dakota for that oil to flow. When you hit pipeline capacity, your differential blows out, and then you get a massive discount on your crude. We need more capacity out of Canada if we want that oil to grow. And the same goes for natural gas, is that it's a smaller molecule, it's easy to produce, we're really good at it, it's associated, it's super awesome, but we have a lot of it, and so it's not always in the spot that we need it, particularly in a power plant in the Northeast, partly because we don't build it and partly because we won't build the pipeline, but it's not always in the correct location. So I would say this is all great, but will regulations just change to where you get every bit of that and you never have a flare? Probably not. You're still going to have some flares.
And I guess there needs to be a substation in the area, kind of like a perfect recipe for that to work. But if there's not a substation and they can't share the line, the load is already full, the capacity of that transmission is full.
That's a good question. It's why I think you're finding that data centers are going where the gas is, so that we don't need to build either A, transmission infrastructure, or B, pipeline infrastructure. All you need to do is trench fiber in so that it's connected from a data standpoint. And trenching fiber in is actually relatively inexpensive. Yes, there's a latency question that's involved in that, and so the application that ends up running in that data center probably shouldn't be latency sensitive. But outside of that, the simplest path forward is build power generation adjacent to gas supply, build load for that power adjacent to power generation, and all of these regulatory challenges around building infrastructure that we still deal with go away.
Absolutely. All right, that was a great question. Do we have another one?
With the ESG story that the former administration was pushing, has there been a movement towards or away from electric frac fleets and electric rigs and all that?
So I would say we absolutely continue to move in that direction, but it was never driven by ESG. It was 100% driven by cost. The cost of fueling a frac fleet using natural gas versus one that runs off diesel fuel is pretty dramatic. When the spread was, and of course it varies depending on the crack spread and ultimately what you have to pay for diesel, but that cost differential at its peak was probably something between $20 and $25 million a year for a single frac fleet. So there was a meaningful financial motivation to move towards natural gas. We continue to transition in that direction even today, regardless of that, just because there's meaningful demand for that. Today it's less so electric, more now a natural gas direct drive solution, gas engine transmission pump, but with the same end result. These gas engines are phenomenally efficient. If you think about the fuel efficiency of your car, the engine's maybe 35% efficient at converting energy available in a gallon of gasoline into mechanical energy that gets used. The rest is lost as waste heat and friction and whatnot. These gas engines are 45% thermally efficient, and so you're burning probably a third less fuel, equivalent energy, to provide the same amount of mechanical horsepower at the end of the day. It's dramatic. And frankly, the engines are a lot bigger. So we take 2 pumps off, we put 1 pump on. Those engines that we were running were dual fuel, so they were probably burning 75% gas, 25% diesel. We replaced 2 of those with one of these large gas engines, and we burn less gas and no diesel. So it really is quite dramatic. So you're going to see that transition continue regardless of the administration that's there, but for financial reasons, not ESG reasons.
Yeah, I would just echo that. I think from the operator side that it's a big economic win if you can use natural gas. So I think that trend's going to continue, and we even plan our operations now around how do we get gas to flow from the infrastructure to our well, so we can go frack it, and then you just turn it around and flow it the other way when you're done. And so that shifted where before it was always thinking about, well, I don't have an option other than using diesel because these are more remote locations. Now we do a lot more planning and development to say, let's make sure we can get natural gas to that site for those initial wells. You've got to have other infrastructure in the area, but that's a lot more prevalent now, so we can build that into our planning.
All right, I know we went over, but we started late, so how about one last question? Because this has been a hell of a panel. You got to make it really good. Okay, maybe 2. Okay.
So on the, we talked about technology on the consumption side. On the production side, what technologies are you monitoring currently that you think are going to make a lead change in the energy production, either on the power or on the oil and gas?
Well, look, on the power side, and we just mentioned Oklo. I mean, there's a huge amount of enthusiasm to see if small modular reactors can kind of crack the price, the price that people expect nuclear to be. So just to throw a number out, last nuclear plant built in the country, Vogtle, $20,000 a kilowatt, had cost overruns, but today I think people still expect some, a new, they call them AP1000s, but a new giant nuclear plant to be $20,000 a kilowatt. Oklo, believes that they can crack $5,000 a kilowatt, maybe even $4,000. Is that possible? I don't know, but it's a really important question that I wish I was closer to. If they can, that is a game changer because it's dense energy, no transmission, at a price that's pretty reasonable. So I'll throw that one out.
Yeah, on the production side, that's a good question. I mentioned the thing that I'm looking for, which is really something that enhances recovery out of an oil well. I don't know that we've cracked that nut yet, but it's the piece of the puzzle I'm watching for, because if you thought about something that dramatically changes our energy outlook here, the idea of doubling the recovery out of every single horizontal well that we drill would be phenomenal. It would put the U.S. in a extremely competitive position in terms of providing oil to the world. So that's what I'm watching for. I haven't seen anything that's really moved the needle. You're seeing Oxy's doing a lot of work in CO2 flooding down in the Permian, and so there is work around enhanced recovery, but I haven't seen anything that's doubling production out of a well yet. I think this was the next one here.
Yeah, so it kind of segues into what you're talking about. So, we've talked about 10% recovery of EUR, and if we could double that, how great that would be for unconventional shale play, right? So we've started to see a big boom to some degree in refracs. So 10 to 15-year-old vintage wells to that now the frac technology is totally different in staging. Do you see that as one of the technologies that actually moves us forward, meaning you're going into an old well, you're cleaning it out, you're going to reline it, and then you're going to refrac it with modern technology? Does that get us a boost into that beyond the 10% EUR that we're stuck at?
So I don't think it ever becomes a meaningful piece of our world. You hit on the key challenge there, which is we have to put a new liner in. And so you're starting with already a suboptimal wellbore from a length standpoint. It's probably only a mile-long lateral if it was drilled that long ago. It may have not been drilled in the best possible direction. We now have to put a small liner in, which limits the rate we can pump water down it at. The ability to put a meaningful modern day completion in there is severely limited in those cases. Not impossible, but relatively limited. We've gotten so efficient drilling a new well today that I think the economics are way in favor of just putting a new well in the ground and putting the new completion in that versus refracking an old well. There are cases where it's going to make sense, and you see some operators absolutely that have that as part of their portfolio. but I think it represents low single digits percentage of completions ever done anytime in the future.
Yeah, I'd echo that. I mean, it's something that we look at when we're evaluating things to buy, but it's usually more of kind of that nice to have on top versus the core, investment thesis. So you can get some meaningful volumes, but it's another nice to have on top of just, you can still drill and complete wells, just so much more efficiently than going back in. So we kind of use it as a bit of an and. So especially if you're going to go drill new wells, whether maybe it's spaced too wide or, some of those things, and you go, drill that new well in and then go and refrac those other ones, and it helps not only kind of protect that well, but it can recharge it. But it's maybe a 5 or 10% nice to have on top. So I think that's right.
And if you remember in 2014 or so, that's when people were really talking about refracs in the Bakken, and they were doing it. But then, the market sort of flipped, and everyone thought when we had the downturn then that people were going to go into refracs. But then the technology, just understanding the well got better. So I would just think about when people always ask about what is the next thing. And I mean, my entire career, I grew up around the business, it's boom and bust, but my entire career, people have been asking about what's that newfangled thing. And in DC or Oxford or, abroad, they'd always say, like, they think it's like a newfangled drill bit or something. And I always try to tell them it's like a incremental knowledge that compounds. And it's really the incremental knowledge of, this type of knowledge that compounds that you get a little bit more out. And so, I'm with Ron in that we haven't figured out like this next step. But I can tell you about every quarter when I go talk to my clients, it feels like they've incrementally done a little bit more. And so we have to be very careful that even in these downturns, people slow down a little bit and they think. If they're not drilling completing wells, they're thinking. And so we get just a smidgen better. And so the better we understand the rock, and to the component about AI, that's huge. So just thinking about that. But with this, I'm going to if you guys have any closing thoughts for any three of you, I want to give you guys the last word. I kind of hammered you a little bit on the wind and solar, so I'd apologize for that, but I won't.
Yeah, we're not an owner of wind and solar, so we don't believe in intermittent generation nor non-energy dense generation. So that's why that is why we are the nation's largest natural gas-fired generator. And we're merging, hopefully if we close this deal, with the nation's largest operator of nuclear plants. So bringing both of those together, true, firm 24/7 power to power the future, and that's what we believe in.
Awesome.
Yeah, I think just a closing remark, kind of going back to what you asked about where's the role for kind of private equity. And so, there was a period of time where it was kind of a little bit the land race for shale, or is just go find those next acres. I think the piece that we've talked about earlier around there hadn't been as much exploration or much kind of stepping out. But just because where the economics were, I think that's something that the private equity groups can bring back to the table is, we're kind of, we don't go way out and do true exploration, but you kind of step out a little bit further. It's the old Wayne Gretzky, skate where the puck is headed. And that's where I think you're seeing a lot of opportunity. And that's, one of the things that we're working on. And we feel like we've, have something to talk about soon, just as we're moving a little bit further out. But, we think that the things that we're doing is going to be what's kind of core production in a few years. And that's what we think we can bring to the table. We'll go find it, develop it up to the point where you can turn it over to the next big player to go and finish it out. So.
Excellent point.
All right, I'm gonna take a step off of the trajectory we've been on for a little bit. Of course, it's been exciting to have a conversation around energy in North America, and it's great to be in a situation where we have to talk about curtailment, I guess, as an issue, because we're using so much energy and have such abundant access to it. But of course, we always like to remind everybody before you leave the room that the energy conversation has to be broader than North America, that we are the lucky 1 billion people. We have access to, on average, 13.5 barrels of oil per person per year. If you're in the lucky 1 billion, you live in Western Europe or North America, South Korea, Australia, Japan, and maybe parts of the Middle East. The other 7 billion people on the face of this earth use on average 3.5 barrels of oil per person per year. They are a quarter of what we do. If you're here in North America, in the United States, you use 19.5 or maybe 20 barrels of oil per person per year. So our energy conversation needs to be a much bigger one than the one we had today, and we need to remember that energy policy should not be focused only on the lucky 1 billion, but how the rest of those 7 billion people are going to find their way out of energy poverty. And so we need to remind the rest of the world, and particularly the people here in North America who are making energy policy, that needs to be part of the framework. So proud to be doing what we do, proud to be partners with everybody in this room who's involved in the energy industry, and think we got a lot of work to do in front of us yet. So thanks for being here tonight.
Absolutely. Well, thank you guys. Give these guys a round of applause. This was awesome. Thank you.